Matthew Bell with InsurancePrescription.com, and today I wanted to go over some of the very basic concepts relating to annuities. What are annuities? What can they be used for? What are the different kinds of annuities? In this video, I am going to go into a couple of different things. First of all, there are really two different main periods in an annuity. The first is the pay-in period, and the second is the payout period. And I'm going to explain a little bit more about this just in a few moments. But the video is essentially going to be divided into some general introductory remarks, then remarks about the pay-in period. That's going to include different funding options that you have with annuities, different tax options that you have with annuities, different investment options. Then I'm going to briefly talk about the concept of annuitization, and we're going to move into the discussion of the payout period, which is the second period. And in that conversation, we're going to talk mainly about settlement options, but also just a few words about uses, and then we'll wrap things up. In general, an annuity is going to be used to provide a steady stream of income, usually in retirement, and usually for the remainder of a person's life. Now, for tax-sheltered annuities, that is TSAs, or what is called a 403B, I invite you to click on the video that I have. I'll put a link down in the description, but I have an entire video presentation just on 403Bs. We're not really going to get into 403Bs. In fact, I'm not going to get into them at all past this remark. But if you have found this video because you are looking for a discussion of 403Bs, I do have an entire video dedicated to that discussion. Now, one way of kind of getting a fix on what an annuity is it's sometimes said that it is a vehicle that protects you against living too long. Now, that sounds a bit strange, but the idea here that's being highlighted is what is called longevity risk. And longevity risk is essentially the risk that you are going to outlive your own money, your own financial resources. You're going to spend your assets all the way down, or your income is not going to be able to keep up with cost of living increases, inflation, or the rising cost of your own health care, long-term care, whatever. An annuity, therefore, is a vehicle that can, in principle, help to fill some of the gap between money that you have, let's say in terms of assets, and money that you may need in terms of an income stream. And we'll kind of explain that more as we go along. In this regard, it is kind of the opposite of life insurance. And here's what I mean. Life insurance is a protection against you dying too soon. And sometimes it's put like that. It's not ideal. There are many, many uses for life insurance, and we'll get into those and have gotten into those in other videos. But one way to think about life insurance is it's able to provide you with a death benefit, or provide your family with a death benefit that is equal to the amount of money that you wish that you could have saved, but you didn't have enough time to save. So, for example, or you didn't have enough time to produce for your family. So let's take an obvious case, and this is mainly focused on income replacement. If there's a 30-year-old who anticipates working for the next 40 years, maybe he's making $100,000 a year, then he is going to bring in, over the course of 40 years, $4 million for his family. Now, I've gone into various ways of calculating insurance need in other videos. I'm not going to repeat myself on that conversation here. Suffice it to say that the calculation that I just did, 100,000 times 40 years, is a fairly clumsy, rough way of looking at it, but it's just to give you a fix on this. If that individual at 30 years old dies prematurely, and tragically, obviously, then the money that his family was expecting him to bring in, $4 million, isn't there. In that case, if that individual had been insured $1 million, $2 million, $3 million, $4 million, that money could be put into certain vehicles, into certain accounts, and can be used to help to provide his family with the money that he was going to earn, but never got a chance to earn. Now, an annuity, on the other hand, is something slightly different. The risk in terms of the life insurance was dying too soon. With the annuity, the risk is living too long. That is to say, you have $1 million of retirement assets, you've got a Social Security benefit, you've got a pension check, whatever you have. But then you find that rising cost of health care, the need for long-term care, the fact that Social Security's cost of living increase may not actually keep up with your experience at the grocery store because of shenanigans that have to do with the consumer price index. Your holding company for your pension, like Sears just recently did, we see this in the news repeatedly with various companies that have reduced benefits in the pension, have cut the pension, have gone into receivership and just a lot of messy things that might have to do with retirement checks. So in any one of these cases, the retiree who's been retired 5 years, 10 years, 15, 20 years may find that he or she all of a sudden needs an increase in income and has no ability built into their portfolio to provide for that. That is one of the powers that an annuity has. The annuity has the ability to provide a person with a guaranteed stream of lifetime income. Now, an annuity contract essentially is going to have three different people, and I'll just mention this briefly. The first one is going to be the owner of the contract. That's the person who's got rights in the contract to make decisions about what settlement options are going to be invoked eventually, who's going to make a decision about how much to put in, how much to withdraw, if it's applicable on a given contract. The second individual is going to be the annuitant. The annuitant is the person on whose life the contract is based. And the final person would be the beneficiary or the survivor. This would be, sometimes there's a joint annuitant. This would be the person who would get policy proceeds in the event that the owner annuitant dies. And generally the owner and the annuitant are going to be the same person, unless the annuitant is a joint situation where you have two people. Now, in general, an annuity is going to work like this. There's going to be a pay-in period and a payout period. This is very typical of retirement vehicles in general, right? You're going to put money into your 401k, and at a later time you hope to be able to take it out. Your employer might put a certain amount of money into a pension plan for you, and at a later time you're going to receive the benefit from that. You pay into Social Security, and at a certain point in time you elect to receive your Social Security benefits. This is the general concept. There's a pay-in period and a payout period to an annuity. Now, they are separated by a thing that is essentially called annuitization. That is where you select some kind of a settlement option, and essentially when you are in the pay-in period of an annuity, the money that you put into that annuity, you have full ownership rights over that money. Now, there may be surrender charges, there may be certain restrictions on accessing that money, but while you're in the pay-in period, that money belongs to you. As soon as you go into the payout period, the money you have in the annuity as a lump sum, as an accumulated value, that amount, so to speak, gets pushed across the table. It now belongs to the insurance company, and what they will do in return is give you a guaranteed stream of lifetime income. Now, there are other settlement options, but that's the basic idea. Now, a person never has to flip that switch, so to speak, and annuitize their contract, but that is what the annuity is essentially geared toward. Exchanging an asset for an income stream. It's changing over something that is going to be this fixed sort of pile of money, and you're going to exchange it for and create, if you want to call it, a pension for yourself. Let's talk about the pay-in period. There are several funding options that you have when you are funding an annuity. One of those options would be a lump sum. You could just deposit a single amount into the annuity. This might happen for any of a number of reasons or in any of a number of circumstances. For example, let's say you have an employer-sponsored retirement account, like a 401k, and upon retirement, you decide you want to roll over the amount or roll over a part of that amount into some other vehicle. You might at that point roll over a portion of that money or all of it into a retirement annuity. Now, please, I'm not advising this. I'm simply saying that is one way in which a lump sum might proceed. Another possibility would be you receive money from a deceased loved one as an inheritance, as a settlement from a lawsuit, or from any of a number of other vehicles that you might have been saving in for years. Savings accounts, CDs, anything like that. The lump sum payment is essentially a one-time payment that you would put into the annuity. On the other hand, you might fund your annuity over a period of time. That is to say, make periodic payments. These payments could be level payments, meaning that you might say, we're going to put in $50 every month for a certain period of time, $100 every month, whatever it is. There may be restrictions in funding a particular annuity. For example, if it's held in an IRA or in a Roth IRA, there are certain limitations on the amount of money that you can deposit into those accounts in a given year. I have entire videos dedicated to this. You can check out, and I will link in the description, videos where I have talked about the traditional IRA, the Roth IRA, 401ks in terms of the limitations that you might run into with respect to income and also with respect to contributions that you make. But the level payments are essentially going to be regular periodic payments of the same size. Now another option is you can have a flexible premium annuity, and in that case you would be also making periodic payments, but here you might make $100 one month, $2,000 at the end of the year, then the next year you might make 3 payments of $600 each, whatever. Now I've touched on this briefly, but let's just make another clearer statement about it. The second option that you have in terms of the kinds of annuities that you can select and that's relevant to the pay-in period is going to be the tax option. Now the tax options are not just, you don't just allow, I'm not meaning you just decide whether you want to pay taxes or not, or your taxes are always a thing. The idea here is that there are several different vehicles. Number one would be a traditional IRA, number two would be a Roth IRA, and number three would be what's called a non-qualified IRA. Now some people use the word qualified as essentially a synonym for a traditional IRA, but in my vernacular here that I'm going to express, qualified simply means that there is a special arrangement between you and Uncle Sam, between you and the Internal Revenue Service. And so in this way of thinking about it, there's a special arrangement that exists with the traditional IRA, and there's also a special arrangement that exists with a Roth IRA. They're different. There are different arrangements, and we'll just briefly sketch that. But in brief, and again, for greater detail, I have entire videos just on the Roth, just on the traditional IRA. But in general, a traditional IRA is going to be funded with pre-tax dollars, which means you're going to get a deduction on the amount that you put in. The amount is going to grow, hopefully grow, tax deferred. You will not be 1099 on the amount of money that you earn in an IRA, and then when you go to take a distribution, you're taxed on the entire amount. There's also a required minimum distribution, and once again, I have an entire video, multiple videos actually, on required minimum distributions, or RMDs, which you begin having to take at 70 and a half, mostly. That means that at the age of 70 and a half, with the IRA, if you haven't started taking money out, you're forced to do it. Now, the second vehicle is the Roth IRA. Roth IRA is funded with post-tax dollars, meaning you do not get a deduction on the money you put in, but it also grows tax deferred. And if number one, you are 59 and a half when you go and take the money out, and number two, the Roth has been open for at least 5 years, then you are not taxed on the earnings in a Roth IRA. Then there are no required minimum distributions for a Roth IRA of this kind. The third option here is going to be the non-qualified annuity, and all that means essentially is that there is no tax-favored status with respect to this annuity. So when you put money in, you do not get a deduction. It does grow tax deferred, but when you go to take the money out, you're taxed on the earnings. Now the third thing, we talk about earnings. There are a couple of different types of vehicles. Two main types, and I'll put in an additional one. Actually, there are any of a number of different ways an annuity could be structured in terms of investments. But the two main options are going to be these. Number one, the fixed annuity. The fixed annuity is going to be similar to something like what you would find with a bank in a certificate of deposit or a CD. You're going to have a certain interest rate that is credited to that account. It's going to be in the contract, and more or less everything about that contract is going to be fully guaranteed. Now, there still may be a guaranteed minimum rate, and then there may be a current rate in that contract, meaning that there could be the potential, given the interest rate environment, for you to make slightly more money than is regarded as guaranteed in the contract. So maybe the contract is guaranteed at 1.5%, maybe the contract is paying out 2.5% currently, and that is apt to vary. If the interest rates go up, maybe it'll pay 3%. If they go down, maybe it will pay 2%. But it will never go below whatever the minimum guarantee is, and that would be specified in your contract. In a fixed contract, the risks are assumed by the insurer, and the insurer also is the one that makes the investment selections. Those are all behind the scenes. From your standpoint, you have a fixed contract with an insurance company that's going to guarantee a certain rate of interest to you while you're in the pay-in period, and that's what we're talking about here, the pay-in period. You do not assume risk in terms of market risk for that contract. There may be a cap on the current rate. Now, the second main type of investment option for an annuity is going to be a variable contract. In a variable annuity, you do assume the risk. So that contract is not fully guaranteed. What happens in a variable contract essentially is there is a separate account that is set up that is invested in the market, and sometimes you will select what investments you want, similar to how you would select them in your 401k plan, and depending on how those investments pan out, That's going to depend on what kind of a benefit you ultimately get from the annuity. So you could lose principal, you could gain more than what you would get in a fixed contract, you could gain a lot more than what you would get in a fixed contract. It all depends on investment experience, and again, you are the one that shoulders the risk, or at least some of the risk, for those investment selections and that investment performance. Variable contracts are regulated by the Securities and Exchange Commission, or SEC, because they're not just a life insurance product, and annuities are generally given by life insurance companies. They are not just a life insurance product because they also have a foot in the door of the market. Now, just a word, insurance companies are often the ones that have annuities available. And part of the reason to think about this is because they actually sort of balance the risk. We talked earlier about the fact that the risk with life insurance was that you were going to die too soon, and the risk with annuity is that you're going to live too long. But life insurance companies are in an interesting position to be able to balance those two risks off for a certain individual. So for a single individual who has a life insurance contract and an annuity with an insurer, regardless of when that person dies, the annuity is going to balance the life contract and vice versa. If they die very, very young, then the insurance company is not going to have to pay out as much in terms of the annuity, but they're going to have to pay out more in terms of the life contract. If the person lives very long, they're going to pay a lot more in terms of the annuity, potentially, but they will not pay a lot more in terms of the life contract. So the two risks somewhat balance each other out when an insurance company is the one that is holding the annuity contract. And bear in mind, these risks are, again, averaged. They apply to aggregates and large groups of people, so it's not necessary for one and the same person to have both in order for that balancing to be successful. Now, a third type, we'll just call it an intermediate type. There are a number of different ones that in between a fixed annuity and a variable annuity that you may find. But one that is somewhat popular is going to be called an equity indexed annuity. Now, this is an annuity that is actually indexed to one of the stock indices, like the S&P 500 or the Dow Jones Industrial Average or the NASDAQ. And what it's going to do, similar to an index fund, is track the performance and try to replicate the market performance of that index. Now, again, some of the risk, this is going to be somewhat intermediary between a variable contract, which is going to have high risk and a potentially high reward, and a fixed contract, which is going to have low risk, but a more conservative rate of interest, right? Crediting rate is going to be much lower than what you could get in the market. It's still, though, the guarantee on a fixed contract is higher than what you would get in one of these other contracts, and that's where the equity index kind of fits in, because they promise a higher return potentially that is going to correspond with one of the market indices, but at the same time they can offer something like a guarantee that would be more similar to what you would get in a fixed contract. Going into detail on this is beyond the scope. I'm just sort of trying to lay out the landscape for you in terms of the options that are available. So we looked at funding options, we looked at tax options, we looked at investment options, and those are all in the pay-in period. So once again, while you put money into an annuity contract, you are the owner of that money. It's on your side of the table. Now, that doesn't mean that you have full accessibility to it, because there may be restrictions based on your age. So for instance, if these are retirement vehicles, then there's generally the 59.5 rule, which states that if you make a premature withdrawal from your annuity, then you will be subject to a 10% tax on top of whatever other taxes may apply. Additionally, insurers may assess a surrender charge on a surrender schedule, which means that from anywhere from 5 years, 7 years, 10 years, I mean, it could literally be anything. There may be an additional charge, a surrender charge, for you pulling your money out early. That is to say, before the contract is supposed to be at full maturation. Often the surrender schedules apply to every deposit that you make. Now, in some cases, there are exceptions or waivers. There are certain withdrawals that are permitted. If the annuitant dies, for example, or if he or she is permanently disabled, sometimes for a first-time home buyer, there are a lot of different factors, and it's beyond the scope of the video presently to get into what those are. Another provision that sometimes applies is what's called a bailout or escape clause, and that mostly applies to those contracts where there's a higher degree of risk. And the idea there is that if the rate of return or if the crediting interest rate drops below a certain threshold, the bailout or escape clause allows you to terminate that contract, usually with lesser or no surrender charges and other things. Look at the fine print, consult whatever advisor or broker or agent you're dealing with. Now, between the pay-in period, where the money is yours, and the payout period, where you slide that asset, you slide that amount, that accumulated amount, over across to the insurance company, there's something called annuitization, and that's a switch you basically throw to settle your contract. There are two different general options that you have. One is an immediate settlement, and the second is a deferred settlement. When an immediate settlement, this is going to be coupled with a single premium or a lump sum deposit. So if you throw $1 million into a contract or $500,000 into a contract and then say, I want to start receiving payments next month, that is a single premium immediate annuity. You have put in a lump sum and you have immediately converted it into an income stream. And this is a very common thing for retirees who are rolling over an amount maybe from a 401k and then trying to convert that asset into an income for themselves. The second kind of an annuity is going to be a deferred annuity. Now this one could be a single premium. You could roll in a bunch of money. For example, you could roll in $1 million. You could deposit $1 million into your annuity and then say, you know what, I want to keep it. The principal is right now belongs to me, and I'm going to reserve the right to convert it into an income stream down the road. But often what this annuity will be coupled with is some kind of a level premium or a flexible premium schedule so that you are putting in money periodically, and then down the road you anticipate perhaps converting that accumulated value into an income stream for yourself in retirement. So payout. The settlement options are going to be those options you're presented with once you decide you want to slide that money across the table or do something with it. Now I should say, one of the settlement options in principle is to simply take a total distribution or take all the money out and just clean the account out and close it down. Now that is not technically a settlement option in the lexicon of most insurance carriers, but it is an option you have. You could take the money that you have and make a 100% withdrawal. Now, it may be subject to penalties for early withdrawal. It might be subject to surrender fees, but if you are free and clear and have no surrender fees and no penalty, then one in principle option that you have would be to take the money out and do what you please with it. But more often, the annuitization or settlement options you're going to be faced with are going to be those that are going to convert that asset into an income stream. And at this point, you're going to change the ownership. The money that's in that account, let's say it's $1 million, no longer belongs to you. That million is going to belong to the insurance company. But what you're going to get in exchange for that is a guaranteed lifetime income or guaranteed income over a period of time that you specify. I'm going to talk about a couple of different kinds here, 3 different kinds. The first one is going to be life. The second will be a life with some kind of a refund, and the third will be one that's less than life, a temporary settlement. So let's talk life without refund, which is sometimes called a pure life, a straight life. Often this is on one individual, just one individual. It offers a high payout rate because it is based on the life expectancy of only one person. So let's say you have $1 million in a contract and they will give you, I'm making these numbers up, but let's say you are guaranteed $50,000 a year for the rest of your life and you are age 70. So you put $1 million in at age 70, you're guaranteed $50,000 a year for the rest of your life. Now if you live 10 years, you will receive $50,000 a year for the first 10 years, and then that contract simply terminates and the money the insurance company did not pay out is simply lost to you. It would go to the insurance company to balance out their risks. They're going to use it to pay for people who live well beyond their anticipated life expectancy. But from your standpoint, that gives you a higher payout for those first 10 years than you would have gotten otherwise. But once you have died, then that money is simply lost to you or to your family. Now this might work if you are a single person, you have no children, you have no spouse, there are no charities or any other places that you would want that money to go, then it might be worth it to you to maximize your benefit. The second option in general is going to be life with some kind of a refund. Now this could literally be a cash refund where at the end of the time where the insurance company is paying you, let's say you die in 10 years, then there's a certain amount of money left in that contract. It could be delivered as cash in a lump sum to some beneficiary, but more often what happens is there's some kind of a guarantee where that check will continue to go to somebody else. So sometimes what we talk about is life with some sort of a period certain. So what that means is, let's say you have life with a 20-year period certain, meaning that at age 70, the insurance company promises to pay you, let's say, $45,000 a year. But if you die in 15 years, they promise to pay a named beneficiary for the remaining 5 years of that guaranteed 20-year period. Now, on the other hand, if you live 21 years and then you die, there would be no check going to your beneficiary because you would have already served that 20-year period. So in other words, they guarantee your life or 20 years, whichever is longer. Now, there are also joint annuitant contracts. There are also survivorship contracts. In a joint contract, which is often termed a first-to-die policy, you may have an annuitant that shares, let's say it's a husband and a wife. You might have an annuity contract on both, but then when the first one dies, the annuity contract terminates. There's also a survivorship policy, or a last to die, or a second to die policy, all different names for the same kind of an idea. And here, it would also be on two lives, but the idea here would be is when the first person dies, the contract is going to continue to pay out to the second person until the end of his or her life, at which point the contract would stop. Now, for every level of guarantee, you will accept some sort of a reduction in the amount of benefit that you could anticipate compared with what you would get if you just had it on your life by yourself, with no additional guarantee. So for instance, if you are guaranteed by yourself $50,000 a year for the rest of your life and $45,000 a year for the rest of your life, provided there's a 20-year guarantee to somebody else if you don't live 20 years, then we would expect the benefit maybe to be $40,000 if you guaranteed it 100% both to you and to your spouse. There are many, many options. Anybody who's seen a pension settlement option form will be familiar with some of these. Survivorship benefits often come in 100%, 75, 66 and 2/3, 50%, 33%, whatever it might be, options that you can select for how much of that benefit you want to leave, if any, for your spouse, for your family, for your loved one. Now, there are also temporary annuities. These might be things where you simply say, I want a certain amount of money for 10 years. I want that contract paid out to me for 10 years. Maybe you are corresponding the payout to a car loan or to a home loan or to some other purpose. There's also a payout structure where you could say, I need $500 a month for as long as the annuity will hold out. And at that point, they'll guarantee a certain amount. But then when that contract pays out, the annuity closes down. Sometimes these, you can think of them maybe as a lottery payout. If you got a settlement from a court or a lottery payout, you might be able to just have that paid out to you over a certain period of time, and then the payments would stop once the funds have been depleted. But once again, the main purpose for an annuity is generally retirement income, and the main options that are selected are usually some permutation of life income for at least one person and possibly for one or more. Now, a number of uses for these things. There are many, many ways that you can use an annuity. You can use an annuity to fund a life insurance policy, possibly for charitable purposes, to leave on as a legacy, to fund a trust, perhaps a special needs trust for a son or daughter that has some kind of a mental or physical incapacity, for grandkids, for education, for some of your family members down the line. You could use an annuity to fund a long-term care insurance policy. I had an instance where a gentleman used an annuity to fund his car payment. So it was not a life payout, but it was a payout over the course of 7 years, and he's using that payout to pay for his car payment. But the main reason that annuities exist, and the main option that people, the main purpose that people put them to, is to provide themselves with a guaranteed stream of income for life in retirement. Now, there are a number of considerations. There are going to be considerations in terms of cost of living pressures. So, for example, a fixed annuity that guarantees you a certain rate may not be may not in itself be able to keep up with the cost of living increases that you would expect to incur. Some people solve this problem by staggering annuities. So, for example, you might annuitize one portion of your money, give you an income stream for 10 years, and then plan to annuitize the second portion in 10 years to sort of give yourself a pay raise, so to speak. Some people prefer variable contracts to try and deal with that risk, but they do then incur the possibility, or they incur the risk that they might lose even the principal in some of those contracts before they annuitize them. Many, many options. I'm not going to get into all of those. I hope, though, that what I have said has been somewhat instructive, and if you found something of value in the video, please like the video down below. Please subscribe to the channel, and thank you so much for joining me today. I look forward to seeing you in another video.